In Chapter 3, you'll learn about the beginning of the accounting cycle. The accounting cycle is the steps that businesses are going to use to record and summarize their accounting information. Those steps start with analyzing transactions from source documents. You've already gone through this step when you were analyzing to determine what account would be debited and credited. Step 2 is actually recording those transactions into a journal. So instead of using T accounts, we're now going to record them in a journal, still using debits and credits. Third, we're going to take that information from the journal and put it into a ledger. And fourth, we're going to prepare a trial balance of the ledger. So you created a trial balance based off of the footings of the T accounts. Now you're going to create a trial balance based off of the ending balances of the ledger. Some definitions to go through. The source documents. So when you're analyzing, you need to use source documents, and those are papers that can prove that the business transaction occurred. Some examples of these would be receipts, sales slips, cash register tapes, invoices, and bills. And it's important that businesses have this proof. That takes us to the principle of objective evidence that states that source documents should form the foundation for recording business transactions. So it's just stating that it's important that every transaction that's recorded is based off of one of those source documents, such as a bill, such as an invoice, such as the cash register tape. And when we record that information, we record it into what's called a journal. And it's a record in which business transactions are recorded in the order that they occur. It's also known sometimes as the Book of Original Entry because it's the first place transactions are formally recorded. We're going to start with a general journal, which is an all-purpose journal, and we're going to record the transactions chronologically during that accounting period. And the process of recording to a journal is called journalizing. I'm going to skip the steps in analyzing a transaction, and I'll come back to those when we do a couple sample problems. And I'm going to move on to the second page of your notes and talk about a compound entry. Compound entry is any entry in the journal that requires 3 or more accounts. And you've dealt with some of these occasionally when you maybe have 2 accounts that are debited and 1 account that is credited. So for example, if the owner invests cash in equipment, let's say the cash was $1,000, equipment was $2,000, those 2 accounts are going to be debited and capital would be credited for the $3,000. Continuing on with an example of how you're going to go about journalizing to the general journal. I'm going to read to you an example transaction that happened on November 1st, and the owner, Stanley Walker, invested $10,000 cash in his business. In your notes, you have a section to record and remind yourself of the steps to go through in analyzing a transaction. The first thing you want to do is determine what accounts are affected by this transaction. So in this case, if Stanley Walker invested cash into his business, cash is going to be affected, and Stanley Walker capital will be affected. The next step is whether the accounts affected were increased or decreased. Okay, if the owner is investing in the business, cash will increase and also capital will increase. And then, did those increases or decreases affect the debit or credit side of those accounts? So if cash is increasing, we're going to be debiting that account. And if capital is increasing, we'll credit that. This is the process now to record it. The very first transaction of the page needs to have the year and the month. So we'll start out with 2000. We'll just do X1, and then I'm going to enter to the next line. And this took place on November 1st, and we record it as of the date that it occurred. So on November 1st, this is when he invested the money into the business. We always record the debit first, so I'm going to start with cash, and then we had $10,000 that he invested. I go to the next line. I don't need to repeat the date. It's the same. And I'm going to indent this. So in Excel, I'm going to use this alignment section to indent and then write Stanley Walker Capital. And now it's on the credit side. And then the last thing we're going to do is a description. So this is going to be indented even a little bit more. And the description is just what happened in that transaction. Invested cash in the business. If you're given a source document, this would be the place that you could indicate that. So if there was a receipt to go with this, if there was a bill to go with a transaction, you could say what bill number it was, what receipt number it was in this location. We'll go ahead and journalize another transaction, and this one occurred on November 6th, and we purchased office equipment for $3,000 on account. So the first thing we're going to do is put the date in. I'm going to skip a line so there's a break in here. And we'll go through the process of analyzing. So first, determining what accounts are affected. If we purchased office equipment on account, office equipment and accounts payable would be affected. Office equipment is going to be increasing and our liability to accounts payable is increasing. So office equipment will be debited and accounts payable will be credited. So I'll go ahead and start recording that. One thing to remember is you always use the account title when you are recording the debits and credits. You wouldn't say purchased office equipment. It's not a description here. It's the actual account title that the business would have in their chart of accounts. And this was for $3,000. Okay, the next one I indent. Anytime I have a credit, I indent the credit account. So this was accounts payable, and that was for $3,000. And then I'll do a description. I'll indent that twice. And we purchased equipment on account. And this is where I can do the description. I don't need the formal account. I'm going to show you one more example. This one's going to be a compound entry. And this transaction occurred on November 30th, where we purchased office furniture for $2,000. We paid $500 down with the balance owed on account. So going through and analyzing what accounts are affected, we bought office furniture, so that's going to be one of the accounts. We paid $500 cash, so cash would be affected, and we owe the rest, so accounts payable will be affected. Office furniture is increasing, cash will decrease, and accounts payable will increase. Okay. An increase to office furniture would be a debit. A decrease to cash is going to be a credit, and a decrease to accounts payable will also be a credit. So we have two credit accounts in this transaction. So we're going to go ahead, enter in the date. Again, I don't need to repeat the month while we're still in the same month and year. And I'm going to do the debit account first. Always need to put the debit first. Okay, and that one does not get indented. And the furniture itself costs $2,000. Okay, now we'll insert the credit. I'm going to indent that. Cash was $2,000. Oops, sorry. No, it was not $2,000. We only paid $500. We still have one more account. And that other account was accounts payable. I'm also going to indent this, but only once so that it aligns up with cash. So we know those two are credits. And I'm putting it on the credit side. And that was $1,500 that we owed. And then I'll still indent twice for the description. So we'll just say purchase, paying part cash. If you'd like to look at more sample transactions, you can find additional ones on page 92 and 93 and 94 of your book. If you feel like you're ready to go ahead and try this on your own, I'd like you to go to page 93 of your book and page 4 of your notes, and you're going to complete the 4 transactions that appear in the middle of the page for Review Quiz 3-1.